Welcome to the Finance Essentials series, where we break down everything you need to know about financing your new home. If you've been putting off buying because you think you need a 20% deposit, you're not alone. Today, we are going to quash the myths and explore your options for getting into a new home sooner. To help us navigate this, I am joined by Mark Polakison, Managing Director of Mortgage Domain. Welcome, Mark.
Thank you.
Thank you. So we often hear that you need a 20% deposit in order to buy a home. Is this really the case?
Not at all. So whilst most people might think you need a 20% deposit, it's not always the case. We do work with quite a few lenders that will ask for a lot less than that. Having a 20% deposit may result in things like reduced costs, such as mortgage insurance. However, you can still enter the market with a 5% deposit. So just as an example, if you were to buy a property for $600,000, you may think that you need $120,000 being 20%. However, we do work with lenders that will only want to see $30,000. You've also got the first homeowner grant, which we can use as part of your deposit as well.
So if someone doesn't have a 20% deposit, what options do they have?
There are actually quite a few different options available to first home buyers with less than a 20% deposit. The first one being the First Home Guarantee Scheme. It's important to note there are limited spots available for the First Home Guarantee Scheme, but it allows first home buyers with only 5% deposit to buy a property and also avoid the mortgage insurance cost. So that could save them quite a lot of money. Another option would be a guarantor loan. So that's when maybe a family member, typically your parents, have a property and there's an amount of equity that we can leverage off to fund your property. So in those cases, a 5% deposit or even less than that will allow you to buy a property. Another benefit of a guarantor loan, it also waives the mortgage insurance costing because we're using your parents' equity. Each of these options have their benefits, but also potential risks. Always do your research and work out what's going to be best for you in the long term.
I'd love to break that down just a little bit further. How does each option actually work in practice?
So with Lenders Mortgage Insurance, or LMI, it's an insurance policy against the bank's money which they're lending to you. Lenders mortgage insurers allow you to borrow up to 95% of the property's value. Also with mortgage insurance, the higher the loan to value ratio, the more expensive the rate can be. So for instance, if you were to buy a $600,000 property and you contributed 5% deposit, mortgage insurance may cost you about $25,000, and in some cases the banks may allow you to borrow that back into your loan. Also, if you were to contribute a larger amount of deposit, the mortgage insurance may reduce because the risk will reduce for the bank. So if you can save up a larger deposit, it can result in cheaper mortgage insurance. Another option is a guarantor loan. So with a guarantor loan, typically your parents or a family member will have a property that's got a sufficient amount of equity which we can use as security to fund your purchase. In most cases, you may not even need that 5% deposit because the banks can lend you up to 100% of your purchase price. With a guarantor loan, it's important to note you have what we call a limited guarantee. That means that the bank is not guaranteeing your full amount of mortgage against your parents. It's usually 20% of the value of your purchase. So as an example, if you spend $600,000 on a property, the limited guarantee or the guarantee that's against your parents' property may only be $120,000. Guarantor loans aren't always fixed for a 30-year period. You might get to a point in maybe 2 or 3 years' time where you've developed or accumulated enough equity to release the guarantor from your property. First Home Guarantee Scheme has been available for many years now. It allows first home buyers to buy a property with only a 5% deposit. The benefits of this means that you don't have to pay mortgage insurance when you apply for this scheme. The remaining 15% is actually guaranteed by the Australian government, and it helps you get into a property and maybe reduce mortgage insurance costs up to about maybe $35,000. There is a price cap, so in metropolitan Melbourne, that price cap is $800,000, and in regional areas of Victoria, that's then reduced to $650,000. Another benefit of the First Home Guarantee Scheme is it allows your interest rate to be potentially a little bit lower. Because these loans are backed by the government, most lenders will actually price your interest rate with the assumption of a 20% deposit. So in most cases, it might save you 0.5% to maybe even 1%, depending on the bank that you approach. It's crucial to weigh up the cost and the benefits when it comes to making the decision, and you want to work out what's going to be best for you.
That's incredibly useful information. Thank you so much, Mark.
It's my pleasure.
Thank you. So if you've been holding off on buying a home because you thought you needed a huge deposit, think again. With options like low deposit loans, government schemes, and guarantor support, you might be closer to home ownership than you think. For more expert advice, stay tuned for the next installment of the Finance Essentials series. We'll see you next time.